Hi friends, Daniel here. In today's video, I want to address the question on whether we should or should not continue our investments if we foresee a potential price decline in the near future. Look, I understand where this concern is coming from. After all, if we expect prices to drop by another 10 to 30%, isn't it better for us to not invest at all and wait for prices to drop? Now, while the concern is valid, it fails to address two things, right? Number one, nobody can time the market. Number two, short-term noises does not affect your long-term performances. Let me explain. Number one, nobody can time the market. I think this statement is pretty self-explanatory. Apart from God, nobody knows if the market is going to go up, down, sideways, or even in circles, right? Anyone who tells you otherwise is probably lying to you. If nobody can time the market, what can we do, right? How can we then manage our investments? To understand how you should manage your investments, you need to first understand the nature of investing. Now, investing is kind of like playing a game of blackjack, right? Essentially, what you're doing in the game of blackjack is to calculate the values of your hands and then decide whether or not it's risky for you to draw the third card, instead of trying to predict what the value of the third card is, right? If the value of the first two cards that you have on your hand sums up to be 20, will you still draw the third card? If the value of the first two cards of your hand sums up to be 11, will you not draw the third card? See, notice how the game is being played based on the assessment of the values of our hands and not based on the blind projection of the value of the third card, right? Just as nobody can predict what the market will be like tomorrow, nobody can predict what the value of the third card would be. The same logic applies between investments and the game of blackjack. But with proper analysis, everybody knows the value of our investments, just as how we can calculate the value of the first two cards in our hands. Okay? In the context of investing, market timing is trying to predict the value of the third card without considering the value of your current hands. While risk management is like calculating the value of your hands and then deciding whether or not you need to draw the third card. I think there's a very clear distinction between these two operations, right? Because the first is just blind speculation, while the second is investments, where you're making probability or you're relying on probability and tilting it to your favor. Now, I'm not here to predict what the value of a third card is, but I'm here to help you make sense of whether or not you should draw or pass your turn, right? That is also why we should be investing consistently via dollar cost averaging, regardless of the market situation. But we need to take precautions as well and manage our risk accordingly based on the value of our hands. Okay. Now, moving on to the second point, short-term noises does not affect long-term profitability. Remember, when it comes to our investments, our strategy is and will always be a long-term strategy. If you invest in things that are fundamentally healthy and growing, your investments will grow in the long run, despite how it will behave in the short run. Okay? Now, there's this quote by Benjamin Graham, who is the mentor of Warren Buffett, and it goes like this. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Basically, what he is trying to tell us is that even shit can be sold at the price of gold if enough people demands it. Okay? But in the long run, people are not dumb, right? We'll eventually come to realize the true worth of the things that we are investing in. And shit being shit, the price of shit will not continue to go at the price of gold anymore. You get me? So what does that mean to us? As long as we are basing our decision on fundamentals and the true worth of our investments, in the long run, the value that we will receive from our investments will be reflective of its true value. To give you an analogy, if I were to put $10 into an envelope and someone comes along and offer you $5 for it, will you sell it to him? The answer is no, because you know that the value inside the envelope is $10 and not $5, right? But what if 100 people come along and all of them offer you $5 for it? Will you sell it to them? Now, if you're objective, you will not sell it to them even though the majority is telling you otherwise, because it simply doesn't make sense. You get me? The value of the envelope is $10, and with proper analysis, you know that it is $10. So you will never sell something that's worth $10 to someone that's offering $5. But if you are easily influenced by what other people have to say, then you will start to doubt yourself and sell the envelope at $5, even though you know fully that it is worth $10. Okay, what does this mean to us, right? When it comes to our investments, we know that we are buying into things that are worth $10 in the future, but we are paying $5 at the moment. Just because 100 or 1,000 people come by and tell us otherwise, it doesn't change the fact that inside this envelope it is worth $10, right? But if someone comes along and offers to sell this envelope to us at a price of $5, I will buy it, right? If someone comes along and offers to buy it at $12, I will sell it, right? The moral of the story is to understand the true worth of our investments and stick to it. When an opportunity or a trap presents itself in the short run, take advantage of it, but never lose sight of what the investment or what the envelope is truly worth. Now, long story short, should we continue our investments despite anticipating price decrease in the near future? The answer is yes, right? Take risks, but also take precaution. We should continue our investments, or rather we should continue investing consistently via dollar cost averaging, as we do not want to time the market. But we should also take precautions and steps to lower our risk when people are offering $12 on a $10 envelope, or even take advantage or take on more risk when people are offering $5 on the $10 envelope. In the long run, by investing consistently, we will ultimately capture the true worth of our investments while making a couple of bucks here and there when people are fearful and avoiding losses, or when people are starting to get greedy by managing our risk accordingly. So that's all I have for the video today. I hope this addresses the concerns that you may have with regards to why we are still sticking on to our investment strategy and why we are still doing the dollar cost averaging, even though we anticipate a potential price decrease in the future, right? Eyes on the price, know the true worth of the investments, and always remember that what we are doing here is long-term in nature. When there are threats or opportunities in the short run, we will take the necessary precaution, just as if I think that the prices are going to decrease in the near future, chances are is that I would have taken steps to lower our risk exposure, right? So stay safe, and I hope to hear from you all soon.